What causes inflation? Inflation is when prices rise across the economy, not one item but broadly. The real meaning: your money buys less than it did before. There are two main engines and they work differently. The first is demand pull inflation. Buyers have more money and want more goods than the economy can produce. Sellers notice they can raise prices without losing customers, so they do. Too much money chasing too few goods. The second is cost push inflation. It starts on the production side. Oil gets more expensive, wages rise, a factory shuts down. Producers' costs go up, and they pass those costs to you. Prices rise even though demand never changed. The pandemic delivered both at once. Government stimulus put money in people's hands, that's demand pull. Meanwhile, supply chains broke and shipping costs spiked, that's cost push. Two engines, same time. There's a third force that's easy to miss: expectations. If workers expect prices to rise, they ask for raises. If businesses expect costs to rise, they raise prices early. The expectation causes the thing expected. That's why the Fed watches anchored expectations closely. Once expectations become unanchored, inflation gets much harder to stop. How is it measured? Two ways: the Consumer Price Index and Personal Consumption Expenditures, or PCE. The Fed prefers PCE and targets 2% a year. Why 2% and not 0? A little inflation keeps people spending rather than waiting for lower prices. Falling prices, deflation, can stall an economy entirely. And that's the connection. When inflation runs above target, the Fed raises the federal funds rate to cool spending down.